Ladies and gentlemen of the crypto space, we're live on a Friday, February 28th at 11:31 a.m. If you're on X or on YouTube, throw your questions into the stream. Let's talk about what's on your mind rather than me just rambling what's on my mind. But obviously, folks are interested in what's on my mind. I see the good in things. I'm an optimist, and the data supports what I see. There's very simple methodology that I deploy that allows the optimistic inspection of the data to be like, all right, cool. This is the course of action. This is the correct course of action. I'm doing the right things. And that is how you pass time. That is how you remain exposed to markets, allowing the markets to actually do what they're going to do. It's baked into the cake, ladies and gentlemen. They're, they're raising the debt ceiling 4 tril. Their need to refinance 10 tril this year. This is all baked into the cake, and that's kind of the title of the stream today. If um, if the world is changing, which I think it may be, depending on what subsequent administrations do, we're talking post 4 years from now. Um, that's interesting. It doesn't play into what's going to happen this year, and that plays into the way a lot of people are thinking. Pretty sure this type of inspection aligns actually with what Warren Buffett has done. Everyone has talked quite quite a bit about his monumental cash pile. I think he was early, and I think he's right. And it all fits into my overall picture and the way I see things. He's right, and everyone's right. This whole thing is going to fall apart, and everyone's afraid that it's going to fall apart, but no one knows when it's going to fall apart. That's because they don't understand the mechanics of the system. Now, Buffett may be right to stack that cash early. It depends on businesses and maybe opportunistic selling, but I think, maybe actually he doesn't give a shit about the blow off top, and that just further is a further argument that's like, all right, it makes sense what he's doing. He doesn't give a shit about a blow off top because that's what's coming. The whole thing is a disaster waiting to happen. The delinquency rate, delinquency on uh, you know retail mortgages, it's above 2008 right now. Um, the interest rates and the collapse of mortgage demand, it's historic right now. The delinquency rate on subprime auto rentals, auto finances and leases, everything appears catastrophic to such a degree that the damn Fed from good old Ben is plotting a minus 1.5 on GDP. The whole system is about to collapse in on itself. Now, 1.5 doesn't seem like much, but when the system is levered to the tits, like it is, minus 1.5 is quite a catastrophe. The system can't contract because then the leverage has a tendency to implode in a cascading kind of way, which is why they raised the debt ceiling 4 tril, which is why who's going to buy the debt, and that's why, in some regards, Doge and administrative policy is causing what it's causing in 10-year yields, and that's a sign of a can kick. Um, we need confirmation of that. We don't have that in technical form yet. What you want to see is this break the 100 on the weekly. You're going to want to see it try and break the 200, but that may be a stretch. That seems like where things are heading. 3 and change seems like a consensus target for interest rates. Uh, higher low, certainly a higher low compared to 0.5, but that would be surely what Michael Guyad wants to see. He wants to see the return of risk off into U.S. debt. So maybe that would make sense in chart form. From like a monthly standpoint, if you zoom out, So you see a massive breakdown, risk off. Equities absolutely do what they did in 2020. You get the flow of capital into US debt, and you breach the 200 on the weekly, and you're falling towards 2.5. That's going to cause a tremendous amount of panic. But if you fall to 2.5 and you hold at a 2.5, you're holding the 200. And when you say you're holding the 200 on the monthly chart of the 10-year, that's insane. That is insane. That's a high or low, and that is a trend invalidation confirmation. But I would suspect we see something like that, 2.5 as a wick, and you hold the 200 with a candle body close because of intervention. I don't think it comes in the form of what people call quantitative easing at the Federal Reserve. That is just a policy dead end. That would be Confluence suggesting they don't have frickin' control and they're now forced to intervene. And that's what everyone thinks. But that is something that they cannot express. So they must deploy whatever um, technique possible to avoid direct intervention from a Federal Reserve standpoint. So these are speculative statements, of course, but that would be interesting to see a 2.5 in a candle body from a monthly perspective, and within 1 month, they create a candle body close above the 200 on the weekly. And this is just a wild expression from the Federal Reserve. Then you don't get minus 1.5. I mean, Raul would probably be like, all right, expected a little bit of negative, and there you go. There's a little bit of negative. But the system cannot work with a minus GDP for the U.S., considering where it's at in the overall construct of financials globally. So with the Congress and the 4 tril bump and the 10 tril needing to be refinanced, my two senses in consideration of what Warren Buffett has done and what he's maybe thinking, things may be changing for the next cycle. Next cycle. We haven't had this cycle yet in crypto. Do I need to reiterate my inspection as to why that's the case? So that's why I really think in terms of 2028, 2029, heading into 2030. So this is a cycle of stacking cash and not reinvesting, for transit cross cycle. It's not like when things start to rip, when no, not that, when the DXY holds 107.35 as resistance. If it does, I'm not going to digress. I'll continue that thought. So holds 107.35 as resistance, starts to fall down. You get to 102, and that's exactly what happened 2 times in 2024. These nice rips of DXY to the downside, and those were your 2 quote unquote bullish periods in 2024. You start the cascade down to the 200. You get your bullish period for 2025, but then you get the break of the 200 to the downside, and that's when you get Super Saiyan 4. And that's when you get your crypto blow off top. That's when you get your crypto bull market, as it's best described, at least historically. I don't have the guppies on. If they want to draw, doesn't look like they want to draw. No, no. Let's turn off the SMAs. Okay. Why? I don't have anything on. I literally have just the super guppies. Why won't it let me draw the SMAs also? Anyway. So, but there's the 200 EMA. Close enough to the 200 SMA for story purposes. That's your bullish period. When you get a punch through the gray guppies, which we had, and that's why this was so bullish towards the end of 2024. That's when you start to have your repricing of the non-Bitcoin space, crypto fintech. When they turn red, that's when things get gross. So we haven't had that. We haven't had that since 2021. There's been no bull market since 2021. So my 2 cents for the remainder of 25 into 26, when you start to see those red guppies, you gain your cash flow and you take it as cash. Cash, 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 cash. There's no buying Bitcoin, buying Ethereum to be like, oh, I'm going to ride the appreciation and sell the top. There's no one times the market other than a couple of folks. But for the majority of people, the appropriate course of action is to take your cash flow as cash and you stack your cash, you stack your cash, you stack your cash. Because when this thing pops, when the dollar pops from its bottom, let's say 98, man, it's going to cause a ruckus. It's going to cause a ruckus. Unlike anything we saw in 24, it's probably going to cause a ruckus akin to 22, January 22, when the dollar bottomed to 22. Okay, do you remember January 22? Everything blew up. Everything blew up. Eventually, the banks blew up in 2023 when this thing just went absolutely parabolic. Absolutely insane to think where things are going to be in mid 2026. So that's exactly why Buffett was early. Buffett was early. He stacked that cash pre-blow off top. He doesn't give a shit. Let's take that as the premise. And he's waiting for the dollar to collapse, for the blow off top, and then the dollar spike, which blows everything up yet again, blows up banks, so on and so forth. And that's when he has already built his cash position. Now, he doesn't care. He doesn't care about a couple years. That is the most important takeaway of his mentality. A couple years doesn't matter. Now, it might matter to him a little bit because of his age, but with regard to the policy of his organization, I would imagine that's going to live on. So time and patience. You buy when there's a discount. So that's straight from Buffett. He calls it blood in the streets, or be greedy when others are fearful. There's been no fearful. This isn't fearful. The dollar running uncontrollably to 130 is fearful. And then we get to see how the administration and policy attempts intervention and then loses control. And Buffett's like, all right, just clean sweeps, just sweeps the floor, as they say in the NFT space, of actual corporations that are cash flow positive, because he's able to just literally bail out the debt position and be like, all right, you had a shitload of debt and your balance sheet doesn't balance, but all right, I'll just take care of that. And the business is cash flow positive. So that's the way Buffett works. So guess what? So if you're stacking cash in 2025, 2026, as all the way up, stacking cash all the way up. All right, great. There's your crypto opportunity to do what Buffett does. Cash, 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 cash. Everything completely blows up. Complete catastrophe. Intervention. You sweep the floor and you're able to acquire at steep discounts. That's my 2 cents of where we are. Uh, why Buffett stacked cash early. He doesn't give a shit about blow off top. He doesn't give a shit about a couple of years. My 2 cents of where things potentially head in the next cycle. Still speculative. How long do they keep things under control for? So that's really the thought of my mind. They have things under control for this cycle. Increasing debt ceiling, they refinance things, they're able to force. I mean, look at all the force the administration is applying to the rest of the world with the tariffs. They're going to put economic pressure such that they buy the debt, at least 4 tril. 4 tril is relatively, uh, it's consumable. They'll force it to be consumed by policy. And there you go for the next run. So, but then you're coming to the point where you have to have a policy, your own policy. You have to have your procedures and your rules, because that's the only thing that protects you. That protects you from the volatility that is going to occur. We all know historically that the crypto space does the massive run up, blows off significantly to the upside, and then collapses. So for the next cycle, you want to prepare now for the next cycle. You get me on that one? It's so important. Is that you don't have to go so far out as Buffett and be years in advance and miss the parabolic nature of the crypto markets being a global market of markets. But you surely should take what he does as a core philosophy A couple years don't matter. Stack cash, wait for things to collapse, then you can acquire. But it's quite counterintuitive to Bitcoin's going 100, 110. It's doing $10,000 candles a week, and everything's going parabolic, especially the altcoins. 10x here, 20x there. You're so tempted to take your cash receipts and buy things. Don't do that. Take your cash as cash. It is what it is. You were able to acquire what you were able to acquire because look, what the hell have we been doing since 22? What have we been doing since 22, 23, and 24? That was the work. That was the time to do the work, not now. Now is the time to prepare for how to behave based on what you did in 2022, 23, and 24. So clearly, I understand the stream's not geared towards newcomers, but that is the time frames you must think in order to optimally and effectively manage capital. Your behavior in a bull market is based on your preparation prior to the bull market. And that sets you up for the next cycle, of which we're going to literally have to do real-time inspection to get a sense of what the hell is going on in 26 and 27 to even begin thinking about the plan of action for 28 and 29. You see what I did there? We're literally in 25. We're thinking about 26 and 27, and we're going to have to reassess how to behave in 28 and 29. That's the amount of that's the time frame, the scale and the scope of what we're talking about here. And that is what is required to effectively manage capital. So from a microscope perspective, looking at today, obviously I've had a bunch of posts about today. 107.35 is such a critical line. And I'll give you that inspection from a 10-year perspective and a DXY perspective. And here's single family residence loan delinquency blows right past 2008 highs, and that is not a topping pattern. That is a straight up and vertical type pattern. And then earlier, 4 hours ago, 107.35, 107.35. So what the hell does this mean when the captain writes a post like that? That's the green line, ladies and gentlemen. It's not just a green line for shits and giggles. It's not just a green line because I said I want to put a green line on a chart. Green line is the resistance in October of 23. That's it. It was right there, 107.35. And then if you zoom out to the monthly and you go back to 1977, it turns out that's a hell of a non coincidental line. It's a significant level because this level is the dollar is a manifestation of the relationship between countries, the structure of financials between countries. So therefore, from a significant standpoint, this might be the most important level on this chart for the entire history of the dollar post $71. Different versions of the dollar throughout history, and post 71 is a different type of dollar. Invalidated the 84 collapse, invalidated the dot-com collapse, invalidated COVID collapse, and whatever the hell is going on right now seems small compared to COVID, seems small compared to dot-com, it seems absolutely minuscule and microscopic compared to the 80s. All indications from a geopolitical collusion standpoint indicate that they've worked out a deal to control the dollar for a period of time. It's always a period of time, because then you go back to the milkshake type concept. It's always just a period of time and a can kick. But that's the point. That's exactly the point. The only way the dollar goes down is a manifestation of geopolitical collusion and intra-country organization and deals and so on and so forth. That's just the way it works. So the monthly is not, I mean, it's obviously constructive, but I like the weekly candles. because it obviously shows the guppies as well. Albeit you can say you punch the guppies, you punch through. There's a blow off bottom through the guppies right into the 200 SMA, EMA on this chart. But then you go over to the weekly and you're like, oh, you get some nice color coded action. You get some red guppies. Clearly a punch through the 200 exponential moving average as well. And that's your crypto bull market, ladies and gentlemen. Not what you experienced in 2024. Nothing. 2023, nothing. 2022, nothing. 2021. That's when the alt space, the derogatory terminology, altcoin space, is 100x across the board. And that is the weird zone. That's when things are disgusting and you're like, oh, it's never going to stop. But that's not the way it works. And that's why we said you stack cash on the way up. You'll never time the top. Who gives a shit? Cash, 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 cash. And then, at sometime at the end of 25, just fricking unload whatever the hell is liquid. Just unload it because it's at 100x on the money. You need to end 25, maybe if you're feeling frisky, sometime early Q1 26, H1 26. You got to unload whatever the hell is at 100x plus. And so, so you see, we're talking 26 or the end of 25, and you just got to unload it at 100x. And that's the only way you know how to do that or why to do that is because of what you did in 25, 24, 23, and 22. So there's no simple answer to folks that are new to this concept of capital management because they're only thinking in terms of today is February 28th of 25. They're only thinking in terms of today and the price of things. But the price of things and what we're doing today is literally a manifestation of not just hindsight of 22, 23, 24. It's literally the actions and behaviors and choices that we did in 22, 23, and 24 to set us up to be where we are today. It's all connected. All connected. Curve at 45 cents. Chart looks good. The inspection or the takeaway from this chart is really it has done nothing yet. This is bottoming. Blow off bottom with a consolidation. And now we're literally at bottom levels. That's it. It's just bottom levels. 2020, 22, 23, blow off bottom in 24, and we're at the bottom. All this indicates from a structural standpoint is when the dollar and liquidity conditions indicate a crypto bull market, it goes parabolic, not from a halfway standpoint, but the whole damn range from bottom. So if anything's at a discount, it still remains to be curved. The complexity there is how do you engage with the protocol? You need to understand your methodology, and that requires so much experience, years of experience. And are you a cash flow, a dividend investor, and you want to own property, or is it just pure capital gains? So that's very hard to teach to new folks because you can't. You can't teach it. This is a journey and a process of developing a rich, robust capital management methodology. It can't be taught. Can't be taught. Andrew, morning cap, much pleasure. Athletic concept. Hi, Captain. Sauna, listening to my financial future is a win-win. Oh man, that there's nothing like a sauna. I'm okay with the United States 165 degrees, but there's nothing like a Finnish or Swedish sauna at 195 degrees. There's nothing like it. That's how you live forever. Really is. Good stuff. Chris, been a while since I said thank you. You have taught me so much over the years. I'm surviving, but it's tough. It's tough. It's tough. That's the point. See, you can't teach that. You can't teach that. You have to experience that. It kind of is the post the other night. It was last night. I did it last night. Here. Crypto fintech portfolio should be up 35% since November. So folks in crypto are like, 35%. I turn $1,000 into $1,350, but The reality is, I talk to um, from a middle class perspective. I'm certainly not wealthy in many regards. It's middle class, so that doesn't work. But 35% is an insane number. There was a time in the stock market when 35% was an insane number. That's not necessarily the case anymore since everything went boomer meme coin. But 35% is crazy. 35% on a portfolio of 10 mil or 100 mil is 3.5 mil or $35 million. 35% is an absolutely astronomical percentage of return since November. And that is just so underappreciated because of just the disgusting expectations of so many folks in crypto. So if you're up 35%, and we could do a real-time inspection of others, it's a little bit higher today. If you're up 39% today from November, your overall portfolio, and it doesn't matter how your portfolio, it could have been an airdrop that has offset balances, which is fortunate, but that's the result of the choices and decisions you've made. Like Shadow has compensated my portfolio significantly. I mean, that counts. You can't say, oh, don't neglect Shadow. What if you didn't get it? No, but you got it. And that's the point because of the things you did. So if your overall portfolio is 30, 40% higher than it was in November, that means you made the right decisions. And that means, yes, obviously, you're probably down 50% from the top of where things were just most recently. That's irrelevant. The market is what defines the value of your portfolio, not your choices and actions, because that's not the type of investor I am. It's not really investing if you capitalized on that change in value. That's gambling and speculation. That the market would do something like this, which is not something, that's not a behavior that I want to engage in, because I can't do that from sitting in a sauna or sitting on a beach. As Hans said in Die Hard, earning 20%. That boy was ahead of his time. All he wanted to do, all Hans wanted to do in Die Hard was sit on a beach and earn 20%. Go figure. That would be such a valuable financial management goal. Just want to sit on a beach and earn 20%. All right, maybe it's unfortunate he was a criminal and we shouldn't really, but anyway, it's a cute thought. That's a classic movie. Yeah, it's not easy to watch the portfolio be volatile. But if you're at 40% from November, it doesn't matter that it was volatile. What matters is if you were right or wrong. And if you're sitting at 35, 40% right now from November, you have data that indicates you were right and your portfolio is correct. And the market is pricing your portfolio, saying you were correct. Andrew, Cap seems Trump is managing a structured bankruptcy. Yeah, that's to a degree. That's something that look, the general public will never understand anything that's going on. Just it is what it is. I don't like talking politics because it's so contentious. Yeah, I'm an empathetic person, very, very, very empathetic, and I understand from the individual standpoint, the loss of a job, federal employment, so on and so forth. These fucking jobs shouldn't have existed in the first place. That's the perversion. Maybe that's a very strong political statement, but that doesn't subvert the empathetic expression. The job should have never existed in the first place. That's what breaks the system. How many? There's 2 million jobs since 2019. What the fuck? What did they do? Oh my God. They gave everyone all this hope that I'm going to have this cushy retirement with a federal, um, federal retirement package or whatever. Ay, dear Lord, the promises. And they promised who was going to pay for that? It was us. Get rid of it all. Get rid of it. Burn it all down. You don't need it. That's not what built this country. This country was built on private sector and rules, fair rules that manage private sector distribution of wealth. You don't want excessive concentration, but you can't solve that with social programs. You, you have to solve that with incentives. How do you incentivize the billionaire to spend the damn money to allow other people to be wealthy? You can't. It's like kids. It's literally just. It's literally this is basic parental psychology. You can't force people to do anything. You can't force kids to do anything. All you could do is incentivize behavior. So that's what the IRS got so wrong. Forceful redistribution. When you force anything on people, they respond the same way kids respond. They will fight it no matter what. And that is what destabilizes society. You want people to say, to opt in, to be, oh, that's a cool deal. I'm going to do that. All right, I got 50 bill in the bank. I'm going to spend 25 bill and create 200,000 jobs, and I need to attract the best talent, so I'm going to pay them 20% more than the, the competitors. So that's the policy that should have been done. Incentive policy to redistribute wealth, not mandatory, I'm going to take your fucking money policy. Because the kid and everyone is going to fight that. It's a natural human instinct. Very contentious what he's doing. Jim Bianco's take on Mar-a-Lago Accord. Yeah, Jim Bianco gets it. He's very great macro analyst. He's few. Forcing allies into long-term debt will with Besson 333 plan and Doge trimming Fed. So this is the setup for what I was talking about earlier in the stream, how things play out differently next time. So this is like what Ronaldo talks about. Nothing stops this train, but the train's changing at the margins, but nothing stops it for the cycle. 4 trill increase in debt ceiling, 10 trill needs to be refinanced. Everything's going to play out as expected. Dollar blows through 200 on the weekly, and you get your 100x across the board in the non-Bitcoin space, which is why I started the whole stream with, what do you do? Stack the cash, because the next time it'll rhyme, but you got a lot of confidence this time that it's going to be different, because everything that you just laid out, Andrew, they got to restructure the system to be healthy. Now, the problem is that's not the way the general public thinks. General public always has a tendency to want to be social. Maybe that's human tendency. That's why socialism is so attractive. Everyone is equal and everything is fair. But that's not humanity. Second, you fight the system. And I'm not talking about the system of rules that humans create. I'm talking about the system of human nature and instinct. And that's why you have the greed component. But guess what overrides greed based on human programming? You know what overrides greed? Incentives. Incentives override greed, because a person could fulfill their greedy desires because of an incentive that is offered. So how do you achieve the desires of equality and economic equality, most particularly? I don't want to talk about other equality right now. But how do you achieve those social desires? Incentive systems that are consistent with human programming. Can't force it on people, because the child will cause people to not conform. So he gets it, Jim Bianco. Sir Joe, President of the Cat First. Sir, yes, sir. If you're on X or on YouTube, please feel welcome to ask any questions. 189 people on the stream. I think we're going to get a lot of questions today. Joe in the house, good morning. Rich, do you think the main deal that is being made is with China, 1985 style Plaza Accord, where we ease at the same time? Yeah. China's in a deflationary collapse. And that is, I'm not even going to look at the data. It's just, it was ongoing. We were looking at their bonds for a bit. It is an absolute deflationary collapse. So the only, and if they deval, the dollar goes to Valhalla. The dollar spikes to 140 and that collapses the world. So China knows this. They all know this. Everyone knows this. So they can't deval without a structural organization and collusion with the United States to manage the cross currency pairs. And that means every other damn country needs to do it also. Because if China devalues and the U.S. devalues so that you suppress the volatility in the currencies, every other country needs to do the same thing. Otherwise, their currencies spike. And if their currencies spike in value, that affects um, whether they're an importing nation or an exporting nation. It changes the entire structure of the country. So, for instance, if Germany doesn't devalue, this is a good example. They're the manufacturing hub of Europe, all of Europe. So if their currency goes through the roof, who the hell is going to be buying anything from Germany? And they're an exporting nation. It's very important to understand how relative currency valuations affects whether a country can be an importer or an exporter. So Germany needs to make sure their currency is properly priced so people around the world can actually come to Germany and buy things. Because if their currency is too expensive, that invalidates them as an exporting nation. So that's why China deval requires the US to deval, requires everyone else to deval as well. Yeah, I think we're at the point where, because of China, you get a structural deval across the board. But that's literally consistent with, dare I say, like Raoul's everything code. Everything is laid out. They need to deval, otherwise, you can't kick the can. If China collapses, they have to sell. They're going to sell everything that they own with regard to the U.S. And it's not just the U.S. debt. It's what Lou Groman says. It's how much of the United States or dollar-denominated assets is owned outside of the world. Well, it just so happens since post 71, we sold everything internationally. I don't even remember how many trillions of dollars are owned internationally based on his conversations. But now everything collapses. So China, every country around the world is existentially dependent on every country around the world, especially China, because of how much they bought around the world. And if they have an economic collapse, they sell everything they bought around the world, which collapses everything they bought around the world. So you nailed it, Rich. That is the bottom line. Good morning, Cap. Much a pleasure, George. Always a pleasure. If you're saying to unload at the end of 2025, early 2026, then the devil's advocate, and why lock anything? Yeah. Well, because the concept of property ownership, that's meaningful psychologically. You want to own things. So the question is, what do you own versus what is liquid, which is a form of cash, as I define it. So it's kind of like the kitchen sink type story. Anything that can be sold at some point must be sold. You got to unload it all. So whatever is, then that's just the concept to keep in mind. So shadow, mm, derivatives, like liquid staking derivatives, pretty straightforward there. What can be sold should be sold. Non-sentient, you contradict yourself way too much. No, definitely I don't. Snoke, if you were currently sidelined, could you summarize what kind of metrics, macro chain, would you be checking? Would you be checking to pull? I can't, Snoke. I can't talk about investing right now. The investing should have been done in 22, 23, and 24. This is what I was saying earlier. It's very, very, very hard to get started with capital management. It's so much easier to think about what you own when you own it. You already own it because the purchase has already been made. You own the property. As I always say, the hardest thing is to get on a moving train. And that's what capital management really is, the acquisition of properties, the acquisition of not assets, the ownership of things. When do you buy? It's the hardest thing in all of this. But that conversation or thought ends once you have bought, you no longer have to contemplate when to buy. Now you're just contemplating from the perspective of what you own, what you already own. So I don't have too much opinion to offer with regard to what to buy. Plus, that's also not something for this conversation. That's for everyone's individual journey to realize, well, what should you own? At what price? It's hard. I don't have the answers to that. I've been very transparent of what I bought over the last years. Um, you know, look at Ramsey's. Ramsey's has been a disappointment since purchase. Arbitrum is suffering from a currency availability standpoint, but sure as hell, it was very nice what Ramsey's exposure offered with regard to shadow exposure. So it's literally compensated for uh, every loss of capital, every bit of loss of capital in Ramsey's just because of the shadow exposure. So that made sense. And what was the narrative there? The narrative there was Ramsey's offers exposure to its growing kingdom. And they chose to do that in airdrop form rather than Velodrome's seamless cross-chain form, superchain narrative. So that is why that is the behavior or the inspection that led us to the shadow exposure. So that's why I say the choices we made in 22, 23, and 24 result in where we are today. So they all get taken into consideration. We had a very good narrative for Ramsey's exposure, even though it was suffering and continues to suffer. The receipts from Ramsey's are quite dismal, to say the least. But literally, just not only the principal valuation of Shadow, the receipts of Shadow, yeah, that was a good choice to own Ramsey's. Um, don't be, what is this? Sidelined. Waiting for what? Answer the question to yourself. What are you waiting for? What are you waiting for? Are you waiting for a sign? Or are you waiting for someone else to say? Don't wait for anyone else. You got to make these choices on your own. So you have to define what you're looking for. I can't, there's nothing I can possibly do to answer that question, my friend. I'm very sorry. We all are on our own journey, and when to buy is the hardest part of that journey. Did you see that Citadel enters the market? Everyone enters the market because what folks need to understand is what I've been saying for years. This is not the crypto space. That's a derogatory terminology. Um, this is a market of markets. This is a fintech market. These are five business pillars, as I've described: foreign exchange, credit, derivatives, liquidity financing, and liability printing. This is banking. These are banking products. So of course they entered the market. These are non-monetized. This is a non-monetized nation state of nation states that offers banking products that are accessible to the entire planet. It's an extraordinary realization once it's finally absorbed, and looks like it's going to be absorbed more and more and more by relatively uh, uh, well capitalized traditional financial institutions. That is very, very real observation. George, why do you not purchase assets now at all? Because I don't need to. That's me. which is why I try and tell the story in a way that everyone needs to find their own path. I'm done because of what I did in 22, 23, and 24. I have reached a state where I own and have exposure to everything and anything I could possibly need to have exposure to. I even took that liquidity bag. I even bought the liquidity bag. Hey, then Arrow just asked, pinging about the question again. Look, what's liquid? So I have the liquidity exposure. All right, great. That goes 100x from here. Dump it. Shadow, they chose not to have a locked type style portfolio or position. Dump it. Everything else is locked. So you have to mentally compartmentalize. Those are not positions. That's property ownership. It's owned because you can't sell it if you wanted to. And it was chosen to be owned because of the exposure it offers to a particular market, arbitrum, optimism, base, whatever. So we had rationale behind the acquisition of why that was a good choice. So that's why you can't sell everything. But the point is, there comes a time where you sell everything that's not bolted down. And there's a couple of things that are not bolted down for me. But the vast majority of what I've chosen to have exposure to is bolted down. There's nothing I can do about it. And look at the Ramses 4-year lock. You literally need to lock every week on Ramses to get the shadow drop. So it made sense. And in hindsight, it was a rational choice for the Ramses exposure that afforded the shadow drop as well. And it looks like that's going to play out very nicely from a uh, at some point sell everything that's not bolted down standpoint. What else do I have that's not bolted down? Liquidity, shadow, obviously. I keep mentioning them. I mean, that's about it. That's about it. And that's okay because everything goes 100x. No one's going to give a shit. That's just such a disgusting number. And that brings us all the way back to the beginning of the conversation about where we are in the macro landscape. We haven't seen a bull market since 2021. So I hope I answered that to a degree, Arrow. Look, you got your LSDs. You got your curve derivatives. It's not bolted down. Anything that's not bolted down at some point is to be evacuated. When? We draw on Warren Buffett's mentality. He was early. He's going to miss blow off tops, but bear in mind his perspective. He's got big corporations to consider, and the process of liquidation isn't so straightforward. Contracts, and you can't time those things. That takes time to execute. But for us, we have liquidity, so we can take part in the blow off top. Hope that helps. Rich, in other words, timing wise, where we are at in the cycle is for traders. Yeah, that's a decent statement. Say this is a constructive contribution. I would say so, because now is not a time to want to learn. You really want to learn in like 22, 23, and 24. You don't want to learn when things are maybe about to go parabolic, but clearly from a trading perspective, that is very consistent with buy low, sell high. So I would say that's a reasonable statement. Others, Snoke was thinking about buying. It depends on what your goals are, what your expectations are. We have to have reasonable expectations. So a lot of my perspective is afforded because of the amount of time I've spent in these markets, and I have a very diversified portfolio. This is a decent story. So, for instance, I have a friend that literally strong Bitcoin centric, maximalist, rightfully so, but chose to acquire some Velodrome. Velodrome's receipts are significantly down. He only has exposure to Velodrome, so he's disappointed with regard to expectations. But as you can imagine, with a very effectively diversified portfolio, all right, velodrome's down. Shadow's blowing out. Curve pays weekly very nicely. Uh, Everything else, Nile pays on a tear. I'm very content with a couple hundred a week, and it all adds up. So that's why over the last years, 22, 23, and 24, and this is something Arrow would appreciate, is I have data. I have data of years, so I could look at a tabular data of month by month over the course of 3 years of the revenue. So for myself in 22, I made more in 23. I made more in 24. So year over year through this, what folks would call a bear market, I literally made more money year after year. And I expect 25 to eventually be that year where it's like, okay, this is what I've been waiting for, where we start to see some of the receipts that were afforded in 2021. 2021, it was just disgusting. $100,000 weekly receipts. So now, after 22, 23, and 24, with the expansion of the portfolio, the additional exposure, the change in narrative, massive change in narrative, my expectation is reasonably receipts that are larger than what occurred in 2021. Stack the cash in 2025. So obviously, this is from my perspective, afforded by a diversified exposure to all of these markets, which means one thing goes down, another thing goes up. The whole portfolio receipts rebalance across the whole portfolio. And I have these years of experience that say year over year, the receipts are going to go up. And maybe they go down. The point is there's receipts. And that brings us all the way full circle to the bias salary conversation. Goes up, it goes down. It's just you're making cash flow. You know, the, obviously all my stories are from my perspective, which means I come from a 2019 perspective. So pre-2019, I had experience in 2016, 2017, and earlier as well. But I remember those markets. I was mining back in 2016 and 2017. So 2019, I had X amount of dollars. I sold off a bunch of IRAs, paid fat penalties, whatever. But I had X amount of dollars that I was able to put into crypto, and let's say it was $1,000. Let's just say, how much am I making weekly compared to the amount of money that I totally put into crypto when I started? I started with regard to my real deployment of capital. And from that perspective, it's all good. Um, 22 is like 2.5x total dollars deployed in 2019, just in claim button receipts. 23 was 3x. 24 was 3.5x total amount of dollars deployed in 2019. And I more or less expect 2025 to be like a 10x total dollars deployed in 2019. Now, I cannot give a path, a playbook for how to achieve that. It's not possible. But that's literally the extent of what we could do in conversational form is to tell stories. And all I could do as a narrator is tell these stories based on my perspective and experiences and try and give insight into each of your individual journeys. Now, there's a very small community on the Captain's Discord. Now, everyone has built a journey over these years, and we're going to have interesting stories to talk about over the next years as we compare and contrast our experiences, our choices that resulted in our respective results. But that's the point of all this. It's for all of us to have a story to tell about why we did what we did. Anywho, as Michael Howell recently said, enjoy the party, but dance near the door. Yeah, but that is only as part of the equation. That's a trader's mentality. I firmly believe in the concept of property ownership, whether it's real estate or crypto, because crypto is more property than anything in the stock market. Stock markets are securities and commodities. So crypto's not. It's by definition property. And that's not even like by definition of crypto standards. That's by definition of legal standards. It's literally written to endless IRS documents. It is property. So property is meaningful. This is a very philosophical concept. What are we as humans? We have our thoughts, our ideas, and property is an extension of who we are as individuals. Our thoughts and ideas, they guide us on what to acquire, what property to own. So that's why property is meaningful. So while Mike Howell talks about the great things he talks about, my story still stands that property is meaningful. So the rules still apply. My rules. Number one, own more property. Rule number two, know when to cyclically stop buying property. Okay, great. That's someone asked earlier why I'm not buying. It was George. Because I know when to stop buying based on my rules for myself. And dance near the door, that's consistent with at some point anything that's not bolted down you sell. Okay, so I described what my expectation is for my behavior. And I have two things that at some point get liquidated. When? Not I don't give a shit about tops when it's a nice number, dollar denominator. And then everything else is property, which is an extension of my personal philosophical belief that owning more property is the appropriate thing to do. I hope that clarifies things. Great question, actually. Good morning, Cap. Soon, always a pleasure, my friend. Peter P. Hey, hey. Joseph, how about this one? Do we seriously still have the shit show that is Coinbase taking your money heartlessly if you send Yes, I'm pretty sure that still exists. They are, this is what, they're a counterparty, meaning they have their rules, which means the systems that they built, and you're at the whim of customer service. Maybe customer service doesn't have a capacity to add a coin to a portfolio, access to WE. Yeah, I haven't used a centralized entity of any kind. Actually, I did once. I did use Kraken to buy $2 worth of DOT because I needed gas. And this was maybe a couple years back. So I needed to buy $2 worth of DOT. So I just don't use centralized exchanges anymore. Once you get your capital into the crypto space, operate on chain. There's more than enough infrastructure to operate on chain other than for off-ramping purposes. And Spritz Finance has been killer at that. They have had complexities recently. But now you have what? Uniswap is offering an off-ramp. And if you're going to you could use a centralized exchange for an off-ramp in the context that you have minimized your interactions with centralized entities. Don't be at the whim of the centralized entity. And that's kind of the historic crypto mantra. The whole point of crypto is to be your own bank, which means centralized exchanges don't have a role in that historic crypto mantra. So you're at the whim of Coinbase and customer service, and all you can do is hammer customer service to give you access to your capital. This is really the issue that I remember years ago describing with regard to commercial bank, who didn't want to give me access to my dead mother's account, and it took over almost 2 years to gain access to it. So I find it much more risky to have exposure to commercial banks as compared to stablecoins, in my opinion. Do you see Shadow as a potential winner of Sonic exchanges? Do you think it has potential to reach curve levels, but on Sonic? Well, it's right now the dominant player on Sonic, other than SwapX, which had a nice run up, 8.6 mil market cap. Sonic sitting at Sonic Shadow sitting at 23.9. Chart looks great. This thing ran off 8, 12x on the money. So it is already the winner. That is what it is. I think the X33 concept is quite unique. Um, it, I'm much more fond of locked positions because I value property. Shadow clearly falls into my, if it's not nailed down, you get rid of it. After everyone who doesn't understand, strict capital management methodology, when they run it up, 50x from here because they just buy, and then we dump it, and that's trading. So that's why I don't like that. That's why all my stories are centered around the concept of property management. So yeah, what is in the lead tends to remain in the lead. That is just a natural law. Ongoing disruptions are very infrequently disrupted. So this has done what it has done for a reason. So then again, invalidations do occur. Uniswap was invalidated by Aerodrome and Velodrome on the respective chains. So nothing is 100% certain. I wouldn't buy Shadow at these levels. So my story is always biased. My story of Shadow is a manifestation of Ramses, which is a manifestation of what, 2024 type conversation. When the hell did we acquire Ramses? I think it was 24. Early 20, I don't even remember. But the point is, I have no insight into acquisitions now, which is why I've said it's nothing I could possibly buy. The exposure is already there. So there's a big fallacy that people think, do I have enough exposure? More, compound. I don't necessarily agree with that. I'm much more of a binary person, meaning you either have enough capital to acquire the exposure that you want, and it needs to be a very specific quantity of exposure, or you don't. If you don't have enough money to get the position size that you want, use that as a means of invalidating an investment consideration. Because the biggest thing we do as investors is not buy things, it's we invalidate things that we want to buy because we don't have enough money to buy everything. That would be an excessively diversified portfolio, resulting in subpar position sizes. So that is a great way to have a concentrated portfolio, but it also requires all of us to be able to define what the hell is an appropriate position size. What's an appropriate position size? And do you have enough capital to have that position size? Hope that helps. Snow, could you define the 5 business categories? Foreign exchange, credit, derivatives, liquidity financing, and liability printing. Foreign exchange is the biggest business on the planet. No, it's not. Credit is the biggest business on the planet. But foreign exchange is it's a very understandable business on the planet. It's literally the concept of trading one thing for another. In crypto, people call that DEXs, but that's what a foreign exchange is. It's changing a dollar for a pound. It's changing a USDC for a shadow. It's an exchange. It's a foreign exchange of one denomination to another. Foreign exchange is a big deal. Credit is bigger. It's the biggest business on the planet. The dollar is a credit product. Excuse me. So if the dollar is credit, credit's the biggest business on the planet. A lot of credit businesses in these crypto markets. Derivatives, STETH, RETH, YCRV, CVXCRV, derivatives, derivative products. Everything that F of X produces, derivative products, leverage tokens. That's big business. CME, Commodities Future Exchange, stuff like that. Big business. Liquidity financing is a bit novel. That's a B2B product, business to business. So there's a business product that affords crypto businesses a capacity to incentivize liquidity depth for their token. Therefore, it's a B2B product. Therefore, that business really needs to think about their revenues such that they have a capacity to finance their liquidity desires. Big business. Those are the V33 exchanges, that's Curve, so on and so forth. Balancer. I mean, that's about it, really. That's liquidity financing. Liability printing. It's a derivative, it's a form of credit. Liability printing are the on-chain stablecoins, of which CRVUSD, Money, Bold, MIM, Sky, whatever the hell they're doing over there at Old School Maker. Those are liabilities. Someone owes something, someone took on risk, someone pays an interest rate. That's liability printing. In historic, traditional financial terms, that's called the Eurodollar market, which is really basically the entire banking system at this point, and the concept of fractional reserve. You don't, what matters is, so how did traditional finance solve fractional reserve? There's nothing backing the dollar, and it's not full faith and credit. It's the capacity to spend it at a dollar. So how did the banking system do that? All the banks peg a dollar to a dollar. The funny thing is, to describe that in crypto terms, the banks programmed, hard-coded $1 to be $1 in their systems. Because if it was based on like exchanges or liquidity balance, one HSBC dollar versus one Chase dollar, the only reason they're a dollar is because they hard-coded it to be a dollar. So we've seen that in the crypto space, funnily enough. Protocols programming it to be $1. But the real way to have a great dollar is to not do that. The real way to have a great dollar is to manage the liquidity. That's why Frax is Frax. They protocol on liquidity. They dominate the liquidity, so they're able to maintain the value of their dollar. Now, Curve does it with interest rates, the dynamic interest rates, and their soft liquidation mechanism just adds to resiliency. Something similar with Liquidity V2, with some caveats, with the capacity to set your own interest rate. That's a big deal. But they manage the value. They actively manage the value of their currency in a free market using interest rates as an incentive system. That's the key. It's all voluntary, based on people wanting to take risk. So those are the 5 business categories. What interests me the most? It's all of them. Not derivatives. I don't like derivatives at all. I have no exposure to derivatives whatsoever. I mean, Curve's all 5 verticals. It might be the only protocol in the crypto space that's all 5 verticals. It's all of them. It's foreign exchange, clearly. It's credit with Llama Lend. It's derivatives with Convex and Yearn and all the Curve derivatives. It's liquidity financing, clearly. And it's liability printing with CRVUSD. And it's child, DeFi.money. It's all 5 verticals. So it offers literally the pinnacle of exposure to the crypto markets and what it offers from a fintech perspective. All 5 business verticals. That does not diminish other businesses from being interesting. All the V33 exchanges are liquidity financing and foreign exchange. Credit, Aave, the king of credit. Derivatives, I'm not too interested. And the liability printing, there's Abracadabra, Sky, I don't even know. I have them here. These are the liability printers. Inverse Finance, Frax, Abracadabra, KeyDAO, if they're even doing anything anymore. Dyad, Spark, which is Sky and whatnot. There's not many liability printers, so who's the ones that do it the most interesting? At least as I define it, there's Curve, CRVUSD, and Liquid EV2 Bolt, because those are interest rate governed liabilities that manage via incentives the value of their currency in a free market. Hope that helps. P2P, yeah, diversification is super important in DeFi because of the circular narrative of the market and how much rotation takes place. Well, bear in mind, diversification is a luxury. So a smaller portfolio, the more concentration is required. You can't afford diversification because you need appropriately sized positions. A smaller portfolio is much harder to manage capital. Money makes money is a traditional statement, and that is still the case, whether it's a crypto market or traditional financials. Diversification affords luxury, as I gave you the story of my friend with the velodrome. They have a significant drop in revenue, velodrome's down, but with the diversification, all that matters is the overall portfolio performance. And that's why I mentioned 22, 23, and 24 for myself personally. 23 was a greater revenue year than 22. 24 was a greater revenue year than 23. And I expect 2025 to be a significantly greater revenue year than 2024. So I have also perspective on these markets that I expect more revenue over time, as not only the principal appreciates, which I don't give a shit about. What I care about is the receipts. Assume 10x fit it, Jesus. My man. Dude, we're going to end on the dollar. 107.32. You get into 100 range from where we are, considering where we've been over the last couple of years. My expectations, and I set very prudent expectations. 10x is quite reasonable. Generally speaking, I expect greater than 10x for total net worth perspective. And I don't give a shit about total net worth for what it's worth. Um, but I think a 10x is quite reasonable. We've seen what meme coins do. And for folks that have the 2021 perspective and the hindsight of 2017, it gets gross when things start to go up. That's when the average person, society, takes notice. They buy things that are going up. And we're not talking about the US, we're talking about the world. And we're talking about the world more than we talked about the world in 2021. This thing has changed, the narrative has changed. It is quite the reasonable expectation to expect everything significantly greater than 10x. And clearly, I state that from a very prudent perspective. 20x? When does it get unreasonable? 30x? 40x? 50x? Yeah, you go above 50x and you're like, maybe 50x, 50x, 50x is 50x in receipts because all that trading and all that interest rates paid on liabilities, it's like 50x in receipts. Right now, Arrow's like 10x in receipts. You folks got to understand, like the receipts right now, that's pure XYZ. It means I'm good with the receipts right now. All I give a shit about is the receipts right now continuing. But that is an unreasonable expectation. Isn't that ironic or contradictory? It's unreasonable to expect my receipts right now to continue. I expect they're going to be higher. So that means I'm meeting my expectations. It's going to be higher. As the dollar finally tops, 107.35 has been sticky over the last 24 hours, give or take. There's a reason it's sticking at 107.35. It's because of 2023 and 1974. Yeah, 1976. Look at that. It's a significant level. It means something. You don't just have, there's no such thing as coincidence. And there's no such thing as saying from a weekly that you did not get over this 107.35 level any time without rejection, rejection, and rejection in 2020. There's a reason this is what the chart shows. It's because the powers that be know the world is not healthy at this level. It will come down. And you will get your period of time weekly. You set? I wish I had the SMAs. You get your period of time here where the guppies turn red. And that gets gross. That's unpredictable. Red guppies, unpredictable. We have a sense of what things could do because of 2024 and what started in the Q4 2024 with non-Bitcoin space. Things started to reprice. So as you come down towards the 102 level, you're going to get non-Bitcoin repricing to the upside. Curve was what, at $1.30, $1.40, and then all bets are off when you start to get red guppies. That's when it just gets disgusting. Last one, SPX. We'll look at futures. I mean, is there a dip? Is there a dip? There's nothing. Well, you'll have social media and you'll have mainstream media commentators say whatever they're saying, but there wasn't even a dip. It's just straight up and to the right. It's a bit of a rolling top between Q4 2024 and now. We could go out to the monthly. There's a decent topping pattern. You don't have any bearish engulfing compared to November 24. So, you start to get below November 24 and you invalidate November 24. Then you have increased confluence of a topping pattern from a monthly perspective. But look what happened here. That's actually quite constructive in August 23. You never invalidated June of 23. Never closed below June of 23. So it took 3 months and you weren't able to invalidate the opening price of June of 2023. So that's a little bit of constructive argument from a monthly perspective. From a weekly perspective, you got to go shorter term. And if you go down to, what was it, the 4-hour, let's turn off the guppies and put on the SMAs. Where was that moving average hit? Yeah. So for a while, I thought the S&P and NASDAQ were going to mean regress to the 100, and that's where we were, but we blew past that. So here's some constructive argument from an SMA perspective on the S&P. 2023, clearly bearish between 22. For 22 was bearish. So let's zoom out a little bit from an SMA. So there's big room to fall, and this chart still looks wild. So this is the time frame that I like the most, 2010. Here's your last 15 years. So you can have a full mean regression to 5100 and be like, all right, what? Did you not expect that to occur? Not you, George. I'm just saying rhetorically. You can have a full mean regression to 4672 and be like, all right, it's literally at the 200 SMA. And clearly we blew past that in 2020, bounce, blew past that in 22, bounce. But that's the whole point. And this is where Buffett will be like, ooh, I got that cash pile. Look at that. Folks, you got to appreciate that. You can have a full collapse of 1,200 points in the S&P, a 20% collapse. It could be in one candle for all I give a shit. You're at the 200 on the weekly. There we look at the monthly. So 2020, it's funny how charts, like, it hit a moving average, like, on point. Literally 2020 was just a 100 mean regression. That's it. That's all it was. So you could literally have a full mean regression to 3724 in the S&P and be like, all right, it's a 100 mean regression. Mean regressions are something that should be expected. It'd be like, all right, you deviated from the mean to the upside. It could go to the average price. So that's meaningful to someone that like me that looks at these long-term perspectives. From a Nasdaq perspective, same thing. Could have an 11.6 mean regression. Notice how in 2020 didn't even hit the 100. So this is strength, tech strength, relatively speaking, compared to the S&P. You can have full mean regression to 1160 on the Nasdaq, which is almost 50%. And be like, all right, it's a 100 mean regression. Now, clearly, the whole world is going to be reeling in that situation. It's going to be crisis after crisis and headlines. You can only imagine the headlines. And then someone like me is like, all right, it's a 100 mean regression on the monthly. Anyhow, hope that helps. It's a bit of a portfolio of my old lithium miners, which have gotten hammered. Lithium prices collapsed. Some have done well because they were absorbed by larger mining companies. A lot of bankruptcies, so a lot of the portfolio has evaporated, but the winners have outperformed. Um, Once they got absorbed, the purchasing companies up 2, 3, 4, 500%. So the portfolio is okay. Is interestingly enough, the traditional finance portfolio for me, I rebalanced quite a bit into Bitcoin and gold. Gold's up 50%. I'm sorry, more. I have some gold that's up 70%. So between the gold and the Bitcoin exposure, which is up 100%, um, the overall composition of the portfolio works out well. So the gold appreciating, the Bitcoin appreciating, and the miners that were acquired going up 2, 3, 4, 500% have overcompensated for the bankruptcies and the companies that just evaporate into nothing because of how complicated mining is. So my 2 cents is I freaking hate traditional finance and I hate that portfolio. But that portfolio, as folks point out, that's part of the non-bolted down shit. That's not property. I don't own that physical gold. I don't own. There's no physical Bitcoin. That's some you know brokerage house shit. Okay, so sell that shit. Let it run and sell it. What do you fucking do? So that's why I appreciate so much more the crypto portfolio and the story that I tell you guys about property and ownership, and why I appreciate locked assets so much because I couldn't sell it if I wanted to. And I love that because that's different. And being different matters. So much of our political landscape and our social situation is about people fearing being different. Meanwhile, I literally I want to be different. I want to be very different. I want to be nothing like everyone else at all. I don't want anything to do with normal. I don't want anything to do with the status quo. I want to be different and think outside the box. I crave different. Just that's just real. DJ, I like your perspective on crypto and changed my mind for sure. Well, I appreciate you. I'm hopeful that everything I've said helps at least one person. That's all I could hope for. And I do this stuff partly for myself because these stories allow me to better understand me and the way I think. And every time I tell these stories, it gets clearer and clearer for both myself and everyone's benefit. That's why I do what I do. How do you get exposure to gold? Any brokerage house, you could call them, and some of them you could do it in the interface maybe, but they have a precious metals desk. I didn't buy, GLD and the ETFs, paper gold. I called the precious metals desk and they add actual bullion in a vault somewhere, hopefully, to the portfolio. So it was pure precious metals desk exposure, not paper shit. Um, but that was years ago. I mean, I think gold was at like 1600, give or take. That was so that was about 50%. More than 50%. What are we at? 2,900, 2,844. Cool. So there's that story. Anyway, ladies and gentlemen, Friday, February 28th, 12:56 p.m. I appreciate you all. 234 people made it to the end of the stream, and you are now hopefully a little bit more rational because of it. It is Friday, so you get to relax over the weekend, try and think differently, write things down, write things down, write things down. It helps so much. The more documentation, the better, because then you can look back. How did I think yesterday? Should I change the way I think? Should I upgrade, modify, iterate? Writing things down makes a big difference. So I wish you all a good weekend. Please try and control the anxiety. And that is should be everyone's goal, to be calm, cool, and collected. I will see you guys and gals next week. Until then, peace.